I'm going to briefly discuss some of the tax aspects of cross-border income trusts. In particular, I'm going to focus on cross-border income trusts with assets or business in the United States. Although the structure has evolved with each of the deals that we've been involved in, there are a number of fundamental aspects that are common to all of them. The first of these is a Canadian publicly listed income trust. That income trust will own, indirectly, through one or more Canadian and/or U.S. subsidiaries, interests in U.S. operating assets or in a U.S. operating business. The final common element to these structures is a loan from the Canadian trust to the U.S. operating business. Interest on that loan is deductible in computing the U.S. operating income, thereby reducing the U.S. level of tax. On the other side of the border, interest on that loan can be flowed through the trust without being subject to tax in the trust, and normally would be subject to tax in the hands of the investors. In most cases, however, investors will typically invest in these structures through a tax-deferred or tax-exempt savings plan or retirement savings account. As a result, we end up with a highly efficient tax flow-through when you combine both the Canadian and U.S. level of tax. Now, although the structure is relatively straightforward if you look at it on paper, the real complexity and the nuance in many cases arises in the implementation. And there are a number of reasons for that. First of all, we need to ensure that we comply with U.S. tax requirements as well as Canadian tax requirements. In some cases, the requirements under the various rules don't necessarily mesh, and as a result, there is some tension. Similarly, there may be tensions between the tax requirements and accounting objectives and requirements and commercial objective requirements. As a result, our great challenge and role is to resolve these issues and make it work so that we ultimately comply with the requirements under Canadian and U.S. tax rules, as well as allowing the parties to achieve the maximum commercial flexibility. One of my key roles as a tax advisor on these structures is to help educate the issuers, the underwriters, and ultimately the members of the public about these structures. With respect to the issuers, our job is not simply setting up the structure and walking away. At the end of the day, our job really is to educate you on how these structures work, what you need to do, and how you need to maintain them going forward so that you can ensure that you comply with the various tax rules that are required to make the structure work. With respect to the underwriters, because these cross-border income trust units are typically sold to retail investors as a yield-oriented product, the tax aspects become much more important when it comes to due diligence. Quite simply, if the tax is greater than expected, the flow-through and hence the yield drops. As a result, when it comes to due diligence, far more attention is paid on the structuring aspects of a cross-border income trust than might otherwise be the case with other types of investments. As a result, our role again is to educate the underwriters as to what the applicable rules are and what we have done to comply with them so that they can get the comfort that the structure is robust and sound. Finally, when it comes to investors, because this is still a somewhat new product, we ultimately have to ensure them that it is one that does meet the requirements of all the applicable rules, that the rules are well established and well defined, and that the structure is robust. In that regard, we think all of those conditions are met, and we believe that the structure does offer investors the ability to access different asset classes that they might not otherwise be able to access in the current market environment. As a result, we think it's an optimal outcome for all of the parties.